We have with us Harsh Dugar, the ED at Federal Bank, joining in on the show right now. Harsh, hi, morning. Good to have you on the show. I want to first talk about the fact that you've raised funds from the IFC. Help us understand whether this gives you a reasonable runway into growth into FY24.
Good morning. Hi, thanks. Yeah, we have raised early. This is the second round which we are going ahead with. The first one we had raised the money about 1.5 years back. Subsequent to that, we also raised money of about 3,040 crore by way of QIP, which was in July end. And another IFC has evinced interest in investing another 958 crores. So they have given the approval. We are waiting regulatory approvals for that part. This entire amount of 3,000 plus 1,000 of IFC, total 4,000 odd crores, is something which will be towards completely growth capital.
Your capital adequacy ratio is strong. Your ratios are impressive enough. You really don't need capital if you have to even maintain the current growth rate. So why have you tapped for more capital? Is this an indication that you would be growing aggressively, or is this just safety capital you've acquired?
A mix of both. We definitely are looking at a growth of about 18 to 20%, which is what we have been guiding the markets for. We see substantial opportunities both in the retail and the wholesale space. The outlook is good in the banking sector. If you look at the rural demand and the urban, both sides are fairly strong. So we would like to leverage on that part. And hence, a large amount of the money, which is definitely going to be towards growth capital. Yes, a safety buffer is something which is always advisable because the regulator has also been guiding banks to have buffer capital for any eventualities as well. But it's largely growth capital.
My next question perhaps is on the liability side. There has been a war to acquire more liability. Every morning I get up, I see an ad which says, come to us, we'll give you better rates than your current bank. There is a war of liabilities. How are you managing it? Because you're right there in the middle, not in the top league, not at the bottom of the pyramid, somewhere in the middle. You cannot give very high cost to acquire liability, but you will have to focus on liability. How are you managing this pull and push equation?
Liability growth, there are two parts to it. One is the fixed deposit, which we incur a cost to it. The other is the CASA piece. The fixed deposit obviously comes at a price. So that's any bank for that matter. We have a reasonably large franchise of 1,370 odd branches. Apart from that, our digital onboarding is very strong. And third, we have enough and more partnerships. So these three things are helping us out a lot. Two things over here. One is in terms of deposits. Very frankly, if you were to raise rates, getting deposits is not an issue. So what we are focusing on is ensuring that the cost of deposits is also managed. So for that, we're focusing on not being at the higher end of the rate curve and managing deposits just to fund the growth in the advances piece. That's one. Second, the 4,000 crores which we are raising, 3,000 which has already come and 1,000 is expected, is also going to help us in terms of funding our growth plan. So that's the two parts of it. Most importantly, what we are looking at is the CASA piece. And more particularly within the CASA, the current account piece, because that's virtually at no cost. And that's something we are at 32% in terms of a CASA share. We're looking to up it, which will help us not just only garner deposits, but also keep our cost of funds low.
What about Fedfina, though? Is the IPO planned for this year?
Yes, very much. It's in the public domain. We filed for the IPO. So we're expecting to do this in this financial year itself.
What is the outlook as well when it comes to your deposit growth? Given that Q1 has been fairly strong for the company, do you think that you can hold up this kind of deposit growth?
Most certainly, yes. I mean, we have demonstrated growth. We have a very robust liability franchise. We have an extremely granular and retail franchise base, which is what enables us to keep it low cost as well. We have been expanding our branches. This year, we're looking at adding about 75 odd branches. Last year, we had added branches. So one, between increase of the branches. The second is in terms of our digital partnerships. They're looking to, and our fintech partnerships, we're looking to add this substantially. So I do not see a challenge in the deposit growth. Yes, there's a fight. Answer is yes. It's more to do with cost. At any cost, at any rate, deposits are available in the market. Like I mentioned earlier, the focus would be and the thrust would be more on CASA piece and deposits, maintaining and ensuring the cost aspect of it.
When I look at banks, the banks have a very strong growth in the unsecured category. That's Federal Bank or HDFC Bank or SBI. But if I look at the real data, which is on-ground data, rural demand, two-wheeler sales, property prices, there is evidence of a slowdown. So the question which perhaps I'm asking every banker is that are they taking undue risk when it comes to the unsecured loans? Because the real economy, which is the rural economy, the bottom of the pyramid category, that is not exhibiting growth. Yet the unsecured category for every banker is going. Is this a risk which could haunt us, or you think it is manageable?
The risks, very frankly, is manageable. If you look at Federal Bank, I'll talk about the industry and then I'll talk about the bank in particular. Yes, there has been concerns raised and there's been a lot of media coverage about unsecured piece gaining share and will that become unmanageable? I don't think so. At the system level, we are facing any risks. Are there concerns? Does this need to be monitored? Answer is very clearly yes. If you look at Federal Bank, I think our share in the unsecured piece has been relatively lower than some of our banking peers, and we're upping it. We're very clear about doing this part in a very calibrated manner, covering and the risks. The one part which is a little different from earlier, today you have the bureau data available, and most of the customers I have come across, even the retail or the corporate side, they're very conscious of the fact that the delayed repayments will actually mess up their credit score, and hence are very particular about doing that part. So that is one. Secondly, there's so much of data available and so much of analytics which enables us in terms of predictive analysis of what the repayment patterns would be is far more easier today than it was earlier. So these things are definitely helping us. Third piece, when you're talking about the rural, I'll just add one thing over there. We do the microfinance piece. We have just about crossed 2,000 crores in terms of our microfinance portfolio. We were at about 450 odd crores in March 22. And we've been going at a reasonably rapid pace, partly because of our low base also. Our experience over there has been quite good. And if you look at the microfinance industry in general, the slippages are extremely low. These people are not somebody who would want to default, and they are by nature people who would like to abide by and pay on time. Yes, there could be nature-related or external factors which may impact the repayment capacity, but the intent is always there to pay. Our experience even on the microfinance piece has been reasonably good.
Thank you for taking time out and joining in, giving us a heads up on how financials are shaping up, as well as an outlook on the overall metrics. So 18 to 20% growth is looking to be maintained. They will be focusing on increasing current accounts. And as of now, no challenges on the deposit growth. Fedfina, this financial year is when we can expect it.